Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. I'd like to wish everybody a Happy New Year and thank you for joining me here on this first edition of Next Level Charting. So we're starting out a new year here in 2020 and it is appropriate. It's 2020 and we want to try to have 2020 vision when we look at our charts. And in order to do that, we have to minimize the distractions. So I want to run through 2019 and show you some of the distractions that were out there and then show you what the chart was telling us. And I think if we can just remember to leave the distractions on the sidelines and focus on what really matters, price action, we can greatly improve our trading and see what is really there in 2020. So here's a price chart for 2019 of the S&P 500. And what we can see is we went up around 7.7% from January until April, 4 months. That was just a massive move. But you know what? That wasn't all, because the advance continued throughout the year. And even though we didn't go straight up, because we can't go straight up. I mean, look here, you can't sustain this type of an advance. And so it's normal to expect that advance to slow and turn into a more of a zigzag advance. So we had a pullback, we had another run to new highs, we had a pullback which turned into a consolidation, and then we broke out to new highs. And if you look at what happened, basically you had two periods. You had the first period where you're up around 17.7%, and then you had the second period where you're up 9.5%. over 8 months. So 9.5% in 8 months is an excellent return. So even if you missed the first 4 months of 17.7%, if you'd had a little bit of patience and waited for the setups, waited for the market to come to you, you could have captured some of that 9.5% that occurred in the latter 8 months of the year. Now, one more thing we've got on this chart is the PPO. And it's the PPO 50-200-0. And when you put that 0 as the last parameter for that indicator, it charts it as a histogram. And so you can see that the 50-day EMA moved above the 200-day EMA in early March. Clearly, when the 50 days above the 200-day, whether it's simple moving average or exponential moving average, you're in some kind of a long-term uptrend. And we know that the market trends up a lot more often than it trends down. And we also know that markets do trend. And this trend extended here for the rest of the year. And it even strengthened as we came into year end, because you can see the 50 days getting further above the 200-day EMA there from November to December. So we've got an uptrend. And the point here is that there were chances to make money in 2019, and there was more than one chance. So let's look at some of the distractions that might have derailed us from taking these chances. So it's interesting because I'm going to talk about minimizing distractions here, and things like Twitter and Facebook and CNBC and the talking heads and the financial news, and I guess you can consider me a talking head as well. But you really need to weed out your feeds and focus just on a few people that fit your type of trading style and analysis and minimize the noise. You can't be reading everything because otherwise it's going to become too distracting and you're going to get analysis paralysis. And so I do have a Twitter account and I follow a few people. I've very few. But one person I do follow is Jesse Livermore, not the real Jesse Livermore, of course. That's just a pseudonym that this person is using, and I think they're associated with O'Shaughnessy Asset Management. But he put in a really nice tweet from Quillette, and it was about minimizing distractions. And so I clicked on that article to read it. And basically, it's talking about going on a news blackout, going in the dark. And yeah, you can't go completely in the dark, But I think there's something to be said here in minimizing the news that we are absorbing, and especially not applying that news to something in the stock market. Because there are a million things affecting the stock market, affecting one person's buying and selling rationales versus another person's or institution's buying and selling rationale. And all that information comes together in the price. And that is why I am focused so much on price. And you will not hear me quoting the news, some news event affecting the price. I don't know really what is affecting the price. And if the news event is affecting the price, I think it is more of a short-term effect, and I don't think it affects the long-term, as we will see. So perhaps the biggest distraction in 2019 was the U.S.-China dispute and the tariff issue. Now, I don't know whether it's good or bad for the stock market, but I do know that it cannot help me as far as analyzing the stock market is concerned. Now, what I did is I went to Google Trends, and this is kind of a back of the envelope assessment, but I was looking for the peak in the search term tariff, as you can see here. So as far as the search term tariff is concerned, you can see it peaked there in May. So in early May, there was a big heat up in the US-China dispute and the tariff issue, and you had another little spike there about a month later. And it's, it got elevated a couple times in the summer and in the fall towards the October-November period. But overall, it did not affect the stock market, as we will see from the chart. So here's the S&P 500 again. And you can see in April, as I pointed out, we're up like 17.7% at the end of April for the year. And then you get the spike in the term tariffs and spike in interest on the U.S.-China trade issue, and the market corrects. Well, the market is entitled to a correction after a big advance. It's the normal ebb and flow of an uptrend. You have a big move, you get extended, and you need to digest those gains, and you do that with a correction. And we had a picture-perfect falling flag, if you will, and then look at that liftoff surge for 3 days where we had a gap and a 3-day advance that gave us a breakout and a move to new highs. And it happened right at the 200-day moving average, and the 50-day EMA was well above the 200-day EMA. So the point here is that if you have been focused too much on the US-China dispute, then you would have missed this bullish setup that occurred at the beginning of June and the breakout. The other big distraction in 2019 was the yield curve. And here I am again on Google Trends, and I'm searching the term yield curve, see how popular it was as a search term. And look at that spike there in August. This is when we had this media frenzy all over the yield curve and how it would suggest that we're moving into a recession. Well, that might have been the case in the past, and it might be the case in the future. But if you analyze the yield curve, you can see that the lead time was anywhere from 6 to 18 months. And that's an eternity as far as the stock market is concerned. So we get this spike in distraction in August with the yield curve, but let's see what happened on the price chart. So this chart here shows two versions of the yield curve. We got the 10-year less the 2-year here, and the 10-year less the 3-month in the lower window. And there's that peak in interest for the term yield curve there in August when the 2-year yield was above the 10-year yield. That's why you had an inversion in the yield curve there. And then you can see you had a inversion at the at the short end of the yield curve, the 3-month, when the 3-month yield moved above the 10-year yield, and you had that inversion in June, July, August, and September. And if you'd watched this, you would have missed what was happening on the price chart. Because first of all, we just had a new high. Second of all, we had a sharp decline in August, but we held above the rising 200-day moving average and above this low. So we had a uptrend still in place. So we hit a little resistance here and pulled back, and then we got a higher low. And so what we have happening here is an ascending triangle. because you have these higher lows coming in. You have the equal highs representing overhead supply. This is a bullish continuation pattern, and you're in an uptrend. That's why it's a continuation pattern and bullish. And then you get the breakout and a really strong November and December and move to new highs. So if you're worried about the yield curve, you would have missed what was happening on the price chart. So the third distraction that we had in 2019 was relative weakness in small caps. But was it really because small caps were weak? Well, no, I don't think it was. Because if you look at the performance of small caps throughout the year, that's the gray line. So small caps were leading there in February. The SML, dollar SML had a bigger gain than the S&P 500. And then small caps moved sideways. But even at the weakest point in 2019 in August, small caps were still up around 6-7%. So they weren't down for the year. I think relative weakness in small caps stemmed from serious relative strength in large caps. Because you can see at the end of the year, the S&P 500 was up 30% versus 21% for the S&P Small Cap 600. So that's why this price relative decline. It wasn't so much because small caps were relatively weak, it was because large caps were relatively strong. And that's why we should have been focused on the S&P 500 and looking for bullish setups in that index. If small caps are underperforming, fine, avoid small caps. But don't throw out the baby with the bathwater and turn bearish on the stock market as a whole. So I ran a little scan. I wanted to end that scan on the 31st of December, so it's going to be 3 trading days before, and so I select that. I picked 170 days, so that'll capture the period from May to December. And I want to know how many stocks were positive in the S&P 500. Rate of change is above 0. And so when I run that scan, I'll get the results, and there you can see 376. So if you had just been picking stocks at random, you would have had a 75% chance of picking a winner in the S&P 500 over the last 8 months of the year. But it gets even better if we look at the rate of change above 10%. So we go, the rate of change is above 10%, and I'm going to run that scan, and then we can see the results, and we can see that around half of the stocks in the S&P 500 were up 10% or more in the last 8 months of the year. So if you've been basically throwing darts at the stocks in the S&P 500, you had a 50-50 chance of picking a stock that was up 10% or more. And if you look at some of these gains, they were quite big in the second half. There you can see Target, AMD, Qorvo leading the way with 50+% advances. And then we go down to the bottom of the list and we can see, well, actually there's 100 stocks here that were up 20% or more. This is 100 on the page. So that means 20% of the stocks in the S&P 500 were up 20% or more. And that's more than enough to work with to make money. So my challenge to you in 2020 is to go on a little bit of a blackout when it comes to the news. Forget about Iran, forget about tariffs, forget about economic data, and watch the price charts to make your decision, because that's where we make and lose money. At the end of the day, you just want to put the odds in your favor. And when the S&P 500 is in an uptrend, the odds of making money are greater than the odds of losing money. And ideally what we want is our profits to outweigh our losses. So that concludes this edition of Next Level Charting. Thanks very much for tuning in, and have a great day.